In 2007, the greatest investor who ever lived made a very public $1 million bet. Warren Buffett bet that a single, boring investment, one that a complete beginner could buy in 5 minutes, would beat a team of the smartest, highest-paid hedge fund managers on Wall Street over the next 10 years. No secret strategies, no fancy research, just one plain investment, bought and then left completely alone. 10 years later, Buffett didn't just win. It wasn't even close. The highly paid experts with all their tools and teams returned a fraction of what his one boring investment did. So what was this magical investment that crushed Wall Street? It was an index fund. And by the end of this video, you're going to understand exactly what an index fund is, how it quietly beats the professionals, how to buy your very first one step by step, and the hidden catches almost nobody warns beginners about. Because index funds are not the risk-free money machine the internet makes them sound like. Stick around because that last part could save you from a very expensive mistake. Welcome to Jecob Finance, where we break down investing in a simple way. But first, a quick disclaimer. This is not financial advice. Now let's get into it. To understand an index fund, we first need to understand what an index even is. So forget stocks for a second. Imagine a classroom of 500 students. Every day, the teacher calculates the average score of the entire class and writes one single number on the board. That number goes up when the class as a whole does well and down when it struggles. That single number representing the whole group. That's an index. In the real world, the most famous one is the S&P 500. It's basically a scoreboard that tracks the 500 largest companies in the United States. Think Apple, Microsoft, Amazon, and hundreds more. When you hear the market went up today, people usually mean this scoreboard went up. It's a quick snapshot of how the biggest American businesses are doing as a team. Now here's the key idea. You can't actually invest in a scoreboard. An index is just a number, a measurement. So a clever solution was invented. A fund that simply copies that scoreboard. That's an index fund. Instead of trying to guess which single company will win, an index fund buys a tiny piece of every company on the list. Buy one share of an S&P 500 index fund, and you instantly own a slice of all 500 of America's biggest companies at once. One purchase, hundreds of businesses. That's instant diversification, and we'll see in a minute why that's so powerful. This idea wasn't always obvious. Back in the 1970s, a man named John Bogle launched the first index fund for everyday people, and Wall Street laughed at him. They mockingly called it Bogle's Folly. Why would anyone settle for just matching the market when highly paid experts promise to beat it? Well, here's where it gets interesting. And this is the part that changed investing forever. Let me introduce two investors. The first is stock picker Steve. Steve is smart and hardworking. He spends hours every week reading reports, watching the news, and hand-picking individual stocks he's sure will beat the market. The second is Index Emma. Emma does almost nothing. She just buys a single index fund every month and goes on with her life. Now, intuitively, Steve should win, right? He's putting in all the effort. But over the long run, it's usually Emma who comes out ahead. And it's not just Steve. Study after study has shown that the large majority of professional fund managers, the experts charging you big fees, fail to beat a simple index fund over long periods of time. This is exactly why Buffett won his bet so easily. So the obvious question is, how? How does doing almost nothing beat the smartest people in the room? There are two big reasons, and the first one is fees. This is where the real magic hides. When you pay an expert to actively pick stocks, you pay a management fee, often somewhere between 0.5% and 1.5% or more of your money every single year. An index fund, on the other hand, isn't trying to outsmart anyone. It just copies the list. No expensive team, no constant trading. So its fee, called the expense ratio, can be as low as 0.03%. Let me make that real. On $10,000, a pricey active fund might quietly take $150 a year. A cheap index fund might take just $3. That sounds tiny, but here's the catch. Those fees compound against you, decade after decade, and over a lifetime, that difference can quietly eat hundreds of thousands of dollars from your final result. Low cost isn't a small detail, it's a superpower. The second reason is diversification. Remember, Steve is betting on a handful of companies. If 2 or 3 of his picks go bad, his whole portfolio takes a serious hit. But Emma owns hundreds of companies. If a few of them fail, and some always do, it barely makes a dent, because the winners in the basket carry the losers. She doesn't need to be right about any single company. She just needs the overall economy to keep growing over time, which, historically, it has. She's not betting on a horse. She's betting on the entire race. Now combine those two things, rock-bottom fees and broad diversification, and let them run for decades, and something beautiful happens. Compounding. Your returns start earning their own returns, snowballing on top of each other. A boring, consistent index fund, left alone for 20 or 30 years, has historically turned modest monthly contributions into life-changing amounts of money. Not because you were a genius, but because you were patient and you kept your costs low. So at this point, you might be thinking, this sounds perfect. Let me put every dollar I have into an index fund right now. And that brings us to the part nobody likes to talk about, the hidden catches. Because index funds are powerful, but they are not magic. And pretending they're risk-free is how beginners get scared out of the market at the worst possible time. Catch number one, an index fund will never beat the market because it is the market. You are mathematically guaranteed to get average returns. Now, average here is actually great. It beats most experts. But if you were dreaming of doubling your money overnight, an index fund is not that. Catch number two, and this is the big one. An index fund gives you zero downside protection. When the market crashes, and it will crash again and again over your lifetime, your index fund falls right along with it. In a bad year, you could watch your account drop 30, 40, even 50%. Nobody is steering the ship away from the storm. You ride the whole thing down. This is why the single most important skill in index investing isn't picking. It's not panicking. The investors who lose the most aren't the ones who bought the wrong fund. They're the ones who bought the right fund and then sold in a panic at the bottom. The market always recovers eventually. The investor who sold does not. Catch number three is concentration risk, and it surprises almost everyone. You'd assume the S&P 500 spreads your money evenly across 500 companies. It doesn't. It's weighted by size, so the biggest companies take up the most space. Today, just a handful of giant technology companies make up roughly a third of the entire index. So when you buy the whole market, you're actually putting a big chunk of your money into a small group of mega-cap tech stocks. If they stumble, the whole index feels it. It's more diversified than picking single stocks, but it's not as spread out as it looks. So how do you actually do this the smart way? Let me walk you through it simply. Step 1. Open an account with a reputable brokerage. Most are free and take about 10 minutes. Step 2. Choose a broad index fund. For most beginners, a simple S&P 500 fund or a total market fund is a fantastic core. Step 3, and don't skip this. Check the expense ratio and keep it as low as possible. Remember, that tiny number matters more than almost anything. Step 4. Set up automatic investing, a fixed amount every month, no matter what the market is doing. This removes emotion and is called dollar cost averaging. I've got a full video on that I'll link for you. Step 5. Turn on automatic dividend reinvestment so your money keeps snowballing. And step 6, the hardest one, do nothing. Don't check it every day. Don't panic in crashes. Let time and compounding do the heavy lifting. Quick word on who this is really for. If you want a simple, low-effort, proven way to build wealth over years and decades, index funds are honestly one of the best tools ever created for the average person. But if you're looking to get rich this month, or you love the thrill of picking individual winners, this calm, boring approach might frustrate you. And that's the secret most people miss. With index funds, boring is the entire point. Boring is what makes it work. So let's bring it all together. An index fund lets you own a tiny piece of hundreds of companies in a single purchase. It beats most experts not through genius, but through rock-bottom fees and broad diversification. It rewards patience and punishes panic. It won't protect you from crashes, and it won't make you rich overnight. But held consistently for the long run, it has quietly built more everyday millionaires than almost any flashy strategy ever has. Warren Buffett bet $1 million on that simple truth. And the beautiful part is, you don't need $1 million or a genius IQ to use the exact same strategy he did.